The year is 2008, and a 28-year-old investor named Michael Burry is sitting in his office, surrounded by spreadsheets and mortgage data that nobody else seems to care about. While the rest of Wall Street is celebrating record profits and handing out massive bonuses, Burry sees something different. He sees a house of cards built on subprime mortgages, inflated property values, and financial instruments so complex that even the people selling them don't understand what they contain. So he does something that makes everyone think he's lost his mind. He bets against the entire housing market. His investors are furious. They threaten to pull their money. Some even try to sue him. But Burry holds firm, and when the crash finally comes in 2008, he makes a personal profit of over $100 million while the rest of the world loses trillions. His fund returns nearly 500% to the investors who didn't abandon him. Now here's what's truly fascinating about that story. It wasn't that Burry was smarter than everyone else, though he certainly was brilliant. It was that he understood something fundamental about how wealth is actually created during economic disasters. While everyone else was panicking or partying, he was positioning himself to capitalize on what he knew was coming. And right now, as we approach 2026, the same patterns that preceded every major market crash in history are appearing again. Only this time they're more pronounced, more dangerous, and potentially more profitable than anything we've seen before. Let us talk about what's actually happening in the economy right now, because the signs are absolutely everywhere, if you know where to look. Corporate debt in the United States has reached levels we've never seen before, exceeding $14 trillion. That's not just a big number, that's larger than the entire GDP of every country in the world except China. Companies borrowed massive amounts of money when interest rates were basically zero during the pandemic, and now those loans are coming due at much higher interest rates. When you combine this with commercial real estate values that have collapsed by 30 to 40% in major cities because of remote work, you're looking at a financial time bomb. Banks are sitting on hundreds of billions in unrealized losses on their balance sheets. We saw a preview of this with Silicon Valley Bank and First Republic in 2023, but that was just the beginning. The Federal Reserve has been trying to engineer a soft landing, raising interest rates to fight inflation without causing a recession, but history tells us that has almost never worked. Every single time the Fed has raised rates this aggressively, a recession has followed within 12 to 18 months. We're right in that window now as we move into 2026. But here's where it gets really interesting. And this is where you need to pay very close attention, because this is where the opportunity lies. Market crashes don't destroy wealth, they transfer it. Every dollar that is lost by someone who panics and sells at the bottom is a dollar that is gained by someone who has the knowledge, the courage, and the resources to buy when everyone else is terrified. Think about the greatest fortunes in American history. The Rockefellers bought up oil assets during the Panic of 1907. Joseph Kennedy accumulated a massive fortune during the Great Depression by buying stocks when they were trading for pennies on the dollar. The Rothschilds famously made their fortune by buying bonds after the Battle of Waterloo, when everyone else thought they were worthless. Warren Buffett, the Oracle of Omaha himself, made his greatest investments during periods of maximum fear. He bought American Express during the Salad Oil scandal, Washington Post during the recession of the 1970s, and went on a buying spree during the 2008 financial crisis when everyone else was convinced the world was ending. His famous quote says it all: "Be fearful when others are greedy, and greedy when others are fearful." So how do you actually position yourself to profit from a 2026 crash? First, you need to understand that preparation is everything. The people who make money in crashes are the ones who prepare years in advance, not the ones who try to react in the moment. Right now, before the crash happens, you need to be building your cash reserves. This sounds boring, and it goes against every instinct when you see stocks and crypto and real estate seemingly going up. But cash is the most valuable asset you can hold going into a crisis. Not because cash itself makes you rich, but because cash gives you options. When assets are on sale for 50, 60, 70% off their previous highs, cash is what allows you to go shopping while everyone else is selling. Think of cash as ammunition. You don't want to run out of bullets in the middle of a war. Financial advisors will tell you that holding cash is a losing strategy because of inflation, and they're right in normal times, but these aren't normal times. If we see a market crash in 2026, the deflation of asset prices will far outweigh any inflation in consumer prices. A house that costs $1 million today might cost $600,000 after a crash. That's a 40% gain in purchasing power, which more than makes up for a few years of 3 or 4% inflation. The second thing you need to understand is debt, and this is where most people get it completely wrong. Consumer debt, the kind that makes you poorer, is your enemy going into a crash. Credit card debt, car loans, personal loans, these are anchors that will drag you down when times get tough. If you lose your job or your income drops during a recession, that debt doesn't go away. It becomes a crushing burden that forces you to sell assets at the worst possible time just to make payments. But here's the nuance that sophisticated investors understand. Not all debt is bad. Strategic debt, used to acquire income-producing assets at the right time, can be incredibly powerful. The key word there is timing. Right now, before the crash, you want to be paying down consumer debt and building cash reserves. After the crash, when assets are cheap and interest rates potentially come back down as the Fed tries to stimulate the economy, that's when you want to be using leverage strategically to acquire assets. Real estate investors understood this in 2010 and 2011. They used low-interest loans to buy foreclosed properties for 30 or 40 cents on the dollar, rented them out for positive cash flow, and then watched as those properties doubled or tripled in value over the next decade. Now let's talk about specific asset classes and how to approach them. Real estate is going to be absolutely critical in a 2026 crash scenario, but you have to be smart about it. The commercial real estate market is already showing cracks. Office buildings in major cities are sitting 30, 40, sometimes 50% empty because of remote work, and that's not coming back. Those properties were financed with loans based on occupancy levels and rental rates that no longer exist. When those loans mature and need to be refinanced at higher interest rates with lower valuations, we're going to see a wave of defaults and distressed sales. This is where the opportunity comes in, but not in office buildings. The smart money is going to be in residential real estate, specifically single-family homes and small multifamily properties in areas with strong job markets and population growth. When the crash comes, millions of people who are stretched thin buying homes at peak prices are going to lose those homes to foreclosure. The rental market will actually strengthen because all those people still need somewhere to live. They just can't afford to own anymore. If you're sitting on cash, this is your moment to become a landlord or to expand your rental portfolio dramatically. You want to focus on properties that are fundamentally sound but financially distressed. A house that was worth $500,000 but the owner bought it with a high-interest mortgage they can no longer afford might be available for $350,000 in a foreclosure sale. You buy it with cash or a low-interest loan, rent it out for $2,000 a month, and you've got positive cash flow from day one plus the appreciation that will inevitably come as the market recovers. The stock market is another area where fortunes will be made, but again, timing and selection are everything. During a crash, everything goes on sale, but not everything is a good deal. A lot of companies that look healthy today are going to go bankrupt when credit tightens and consumers pull back spending. The companies you want to focus on are the ones with strong balance sheets, little debt, consistent cash flow, and products or services that people need regardless of economic conditions. Think about companies that sell food, utilities, healthcare, basic consumer goods. These are defensive stocks that will drop during a crash because everything drops, but they'll recover faster and stronger than speculative companies. Warren Buffett's portfolio is a masterclass in this approach. He owns stakes in companies like Coca-Cola, which people drink in good times and bad, Apple, which has a customer base that's almost cult-like in its loyalty, and American Express, which makes money on every transaction regardless of the economy. During the 2008 crash, he also made strategic investments in companies like Goldman Sachs and Bank of America, getting preferential terms because he was providing capital when they desperately needed it. You might not have Buffett's billions, but you can apply the same principles on a smaller scale. When the market crashes and blue-chip stocks are down 40 or 50%, that's when you start buying. Not all at once, but gradually averaging in as prices fall. Cryptocurrency is going to be a wild card in the 2026 crash, and opinions on this are going to be all over the map. Some people believe Bitcoin and other cryptocurrencies will serve as a safe haven during economic turmoil, similar to gold. Others think crypto will crash even harder than traditional markets because it is still largely speculative and driven by liquidity. The truth is probably somewhere in between. If we see a liquidity crisis where people need to raise cash quickly, everything gets sold, including crypto. We saw this in March 2020 when Bitcoin dropped from about $9,000 to under $4,000 in a matter of days. only to rally to 60,000 within a year. The lesson here is that if you believe in the long-term potential of cryptocurrency, a crash is an opportunity to accumulate at much lower prices. But you have to have the stomach for volatility and the cash reserves to buy when prices are clearing. Dollar cost averaging into Bitcoin or Ethereum during a crash, buying a fixed amount every week or month regardless of price, can be an extremely effective strategy. Just make sure you're not putting money into crypto that you need for anything else, because the volatility can be extreme. Gold and precious metals deserve mention because they historically perform well during economic crises. Gold doesn't pay dividends or interest, and it doesn't grow or produce anything, so it's not a long-term wealth builder. But as a store of value during times of currency debasement and economic uncertainty, it's proven itself over thousands of years. If we see a crash in 2026 followed by aggressive monetary stimulus from the Federal Reserve, which is almost certain, gold could see significant appreciation. The key is to view precious metals as insurance, not as your primary investment strategy. Holding 10 to 20% of your portfolio in physical gold or silver, or in gold mining stocks which offer leveraged exposure to gold prices, can provide a hedge against the worst-case scenarios while still allowing the rest of your portfolio to be positioned for offensive opportunities. Let's talk about income and employment, because this is where a lot of people miss the boat entirely. During a recession or depression, unemployment spikes, businesses cut costs, and wages stagnate or decline for most workers. But, and this is crucial, not all industries are affected equally. Healthcare continues to need workers. Technology companies that are well capitalized continue to hire. Skilled trades like plumbing and electrical work are always in demand because houses still break regardless of the economy. The worst place to be during a crash is in a job that is easily replaceable or in an industry that is heavily dependent on consumer discretionary spending. Luxury retail, hospitality, entertainment, these sectors get hammered. The best place to be is in a role where you provide essential value that can't be easily outsourced or eliminated. Even better is to have multiple streams of income. A side business, freelance work, investment income from rentals or dividends, these additional income sources can be the difference between thriving and surviving during tough times. Start building these income streams now, before the crash, so they're established and producing cash flow when you need them most. Now here's something that almost nobody talks about but is absolutely essential to understand. The psychological game of investing during a crash is harder than any of the technical or financial aspects. When the market is dropping 5% a day, when your neighbors are losing their homes, when the news is full of doom and gloom and experts predicting the end of capitalism, your brain is going to be screaming at you to sell, to get out, to preserve what you have left. This is not a hypothetical. This is human nature hardwired into us over millions of years of evolution. Our ancestors survived by running from danger, not by calmly analyzing whether the rustling in the bushes was a lion or just the wind. But in investing, this instinct is your worst enemy. The people who make money in crashes are the ones who can override their fear response and act rationally when everyone else is panicking. This is why preparation is so important. If you've already decided in advance what you're going to do, if you've already set your criteria for what assets to buy at what prices, if you've already committed to a strategy, it's much easier to execute when the moment comes. Write down your plan now. Literally put it on paper. When the S&P 500 drops 40%, I will invest X amount in these specific index funds. When houses in my area drop 30% from peak, I will start making offers on properties that meet these criteria. Having this written plan is like having a map in a storm. It keeps you oriented when everything around you is chaos. The concept of contrarian investing is worth diving deeper into because it is the core of how wealth is transferred during crashes. The crowd is almost always wrong at extremes. When everyone is euphoric and buying, that's when assets are overpriced and dangerous. When everyone is despairing and selling, that's when assets are underpriced and represent opportunity. This isn't just theory, it's backed by every major market cycle in history. The problem is that being a contrarian is emotionally difficult. You're going against the crowd, which means you're going to feel wrong most of the time. You're buying when smart people are telling you you're stupid. You're holding cash when your friends are bragging about their investment gains. You're getting excited about a crash when everyone else is depressed. This takes a special kind of mental fortitude, but it's also where the rewards come from. The way to build this contrarian mindset is to study history. Read about past crashes and how they played out. Understand that what feels unprecedented and different is usually just history repeating itself in a slightly different costume. The more crashes you study, the more patterns you'll recognize, and the less scary the next one will feel. There's also the matter of protecting yourself from the worst-case scenarios. While we're talking about opportunities in a crash, we also need to acknowledge that crashes can be devastating if you're not prepared. People lose jobs, lose homes, lose retirement savings. The goal is to position yourself so that even in the worst case, you're okay. This means having an emergency fund before the crash happens. Financial advisors typically recommend 3 to 6 months of expenses in an easily accessible savings account. In a pre-crash environment, you should be aiming for 12 months or more. This might seem excessive, but unemployment during recessions can last much longer than a few months. And having that cushion means you're not forced to sell assets at depressed prices just to pay bills. It also means you have the financial and emotional breathing room to look for opportunities rather than just scrambling to survive. Insurance is another often overlooked aspect of protection. Health insurance, disability insurance, liability insurance, these aren't exciting topics, but they're what keep a bad situation from becoming a catastrophic one. The last thing you want during an economic crisis is to have a medical emergency wipe out your savings or a lawsuit take your assets. Let's get specific about timing because that's what everyone wants to know. When exactly will this crash happen? The honest answer is that nobody knows for certain. Anyone who tells you they can predict the exact timing of a market crash is either lying or deluding themselves. What we can do is read the indicators and understand that we're in a high-risk environment. The yield curve, which is the difference between short-term and long-term interest rates, has been inverted for an extended period. This has preceded every recession for the past 60 years. Corporate earnings are starting to miss expectations. Consumer savings rates have dropped while debt levels have risen. Credit card delinquencies are increasing. These are all warning signs that stress is building in the system. The crash could come in early 2026, mid-2026, or it might hold off until 2027. What matters more than the exact timing is that you repositioned in advance. Because once the crash starts, it's too late to prepare. The opportunities go to those who have cash ready and the courage to deploy it, not to those who are still trying to figure out what to do. One of the most powerful strategies for profiting from a crash is understanding market cycles and knowing where we are in the cycle. Markets don't move in straight lines. They go through periods of expansion and contraction, boom and bust, euphoria and despair. These cycles are driven by a combination of economic fundamentals, credit conditions, and human psychology. Right now, we're clearly in the late stage of an expansion cycle. Asset prices are high, valuations are stretched, credit is abundant but tightening, and optimism is starting to crack. The next phase is the contraction, the crash. After that comes the depression or recession phase where prices stay low and pessimism dominates. And finally, there's the recovery phase where prices start to rise again and a new expansion begins. The key insight is that each phase of the cycle offers different opportunities. The late expansion phase, where we are now, is the time to be defensive, to be building cash and reducing risk. The crash phase is when you start to get aggressive, deploying capital into assets that have been oversold. The depression phase is when you re-accumulating heavily because prices are at their lowest and pessimism is at its peak. And the recovery phase is when you're holding and letting your investments appreciate. Most people get this backwards. They're aggressive when they should be defensive and defensive when they should be aggressive. Another dimension to consider is global markets and diversification. A crash that starts in the United States will likely spread globally because of how interconnected financial markets are. But not all countries and regions will be affected equally. Emerging markets that are less dependent on U.S. consumer spending might actually offer opportunities. Countries with strong commodity exports could benefit if those commodities are still in demand. The point is not to put all your eggs in one basket geographically. If you have the capability to invest internationally, whether through foreign stocks, real estate in other countries, or simply holding assets in different currencies, you're spreading your risk and increasing your potential opportunities. The US dollar tends to strengthen during global crises because it is still the world's reserve currency and safe haven. But after the initial crisis passes, other currencies can outperform as they recover. Let's talk about some specific examples of how ordinary people, not billionaires or hedge fund managers, position themselves to profit from past crashes. In the aftermath of 2008, a school teacher in California, used her savings to buy a foreclosed condo for $75,000. She rented it out for a small positive cash flow and sold it 8 years later for $220,000. That's nearly a 300% return plus the rental income she collected along the way. A young couple in their 30s took the severance package from their layoffs during the 2008 crisis, and instead of just looking for new jobs, they started a business helping other companies downsize and restructure. They built that business over the next decade and eventually sold it for several $1,000,000. An investor in his 50s kept his job but used his savings to buy stock in major banks like Bank of America and Citigroup, when they were trading for a few dollars a share because he believed the government wouldn't let them fail. He was right, and those investments multiplied 5 to 10 times over the following years. These aren't stories of people who got lucky. They are stories of people who saw opportunity in crisis and had the preparation and courage to act on it. The mindset shift you need to make is to stop seeing crashes as disasters and start seeing them as resets. They're painful in the moment, absolutely, but they serve an important function in the economy. They clear out bad investments, bankrupt companies that were never profitable, reset prices to more reasonable levels, and create opportunities for new growth. Think of a crash as a forest fire. It's destructive, but it also clears out the deadwood and allows new growth to flourish. After every major crash, we see innovation and entrepreneurship surge because the old guard has been weakened and there is room for new ideas. Some of the biggest companies in the world were started during or right after recessions. Microsoft and Apple were both founded in the mid-1970s during a recession. Google went public in 2004 after the dot-com crash. Uber and Airbnb were started during the 2008 financial crisis. Economic downturns create needs that entrepreneurs can fill, and they also create opportunities to acquire talent and resources cheaply. For those who are younger and earlier in their careers, a crash in 2026 could be the opportunity of a lifetime. If you're in your 20s or 30s, you have decades of earning and investing ahead of you. Starting your serious wealth building during a crash means you rebuying assets at generational lows and then riding the recovery wave for 20 or 30 years. This is exactly what baby boomers experienced who started investing in the early 1980s. They bought stocks and real estate at depressed prices and enjoyed a 40-year bull market. The flip side is that if you're older and closer to retirement, you need to be more careful. You don't have as much time to recover from losses, so preservation of capital becomes more important. This doesn't mean you can't benefit from a crash, but it means you need to be more selective and possibly more conservative in your approach. Focus on income-producing assets with less volatility rather than going for maximum growth. Education is another investment that pays dividends during and after crashes. If you lose your job or have reduced hours during a recession, use that time to develop new skills. Learn to code, get a professional certification, take online courses in fields that are growing. Technology, healthcare, renewable energy, these are sectors that will continue to grow regardless of economic conditions. The time you invest in yourself is the one investment that can never be taken away and that compounds over your entire lifetime. Similarly, building your professional network during tough times can be incredibly valuable. The relationships you form when times are hard tend to be stronger and more genuine than those formed during boom times. Help others when you can, offer your skills and knowledge freely, and those connections will pay dividends when the recovery comes. We should also address the role of government policy in all of this, because governments don't just sit back and let crashes happen without response. When the crisis hits, we can expect massive intervention from the Federal Reserve and the federal government. Interest rate cuts, quantitative easing, stimulus programs, bailouts for key industries, these are all part of the playbook. This intervention will create its own set of opportunities. When the government starts buying bonds and pumping liquidity into the system, that money has to go somewhere. Historically, it flows into risk assets, stocks, real estate, commodities. The recovery phase after a crash is often explosive, precisely because of this government intervention. The investors who bought during the crisis and held through the intervention phase are the ones who see the biggest gains. This is what happened in 2020 with the COVID crash. The market dropped 35% in a month. The government and Fed responded with trillions in stimulus, and the market not only recovered but went on to hit new highs within months. Those who bought in March and April of 2020 saw incredible returns. Tax strategy is something else to think about carefully. Capital losses can be used to offset capital gains, which means that if you're strategic about when you sell losing positions, you can reduce your tax bill and have more capital to deploy into opportunities. Roth IRA conversions during a crash can be extremely powerful. You pay taxes on the conversion when values are low, and then all future gains grow tax-free. Real estate investors can use 1031 exchanges to defer taxes when selling properties and moving into better opportunities. Working with a knowledgeable tax advisor or CPA during a crisis period can save you significant money and increase your effective returns. The tax code is complex, but it's full of opportunities for those who understand how to use it legally and ethically. What about starting a business during or after a crash? This might seem counterintuitive, but recessions and depressions can be excellent times to launch businesses. Competition decreases because weaker businesses fail. Talent is abundant and cheaper because of unemployment. Rent and other operating costs come down. Customers are looking for value, which rewards businesses that can deliver quality at reasonable prices. Service businesses, particularly those that help companies cut costs or improve efficiency, tend to thrive. Companies still need IT support, consulting, accounting, legal services, marketing. If you can position your business to solve real problems that companies face during tough times, you can not only survive but thrive. Product businesses need to focus on essentials or extreme value. Discount retailers did well during the Great Depression. Dollar stores thrived during the 2008 recession. E-commerce platforms that help people save money or start side hustles can boom during downturns. The final piece of this puzzle is having the conviction to stay the course. Making money from a crash isn't a get-rich-quick scheme. It requires patience, discipline, and the willingness to endure uncertainty and criticism. When you're buying assets that have fallen 60 or 70%, you don't know when they'll recover. It might be 6 months, it might be 3 years. During that time, you'll question yourself. Other people will tell you you're wrong, and the assets might even drop further before they recover. This is the price of admission for life-changing returns. Every great investor has stories of positions that look terrible for years before finally paying off. The way to maintain conviction is to base your decisions on sound analysis rather than emotion. If you've done your homework, if you understand the fundamental value of what you're buying, if you've bought with a margin of safety, then you can weather the storms and hold until the recovery comes. Remember that the market is a voting machine in the short term, but a weighing machine in the long term. In the short term, prices are driven by emotion and sentiment. In the long term, prices reflect actual value. So here's your action plan as we head toward a potential 2026 crash. Start now by getting your financial house in order. Pay down high-interest consumer debt. Build your emergency fund to 12 months of expenses. And start accumulating cash above and beyond that emergency fund for investment purposes. Educate yourself on the asset classes we've discussed: real estate, stocks, precious metals. Study past crashes and understand how they unfolded. Create your written investment plan with specific criteria for what you'll buy and at what prices. If you don't have these skills yet, start developing them. Learn about real estate investing, take an investing course, read books by successful investors. The knowledge you gain now will be worth more than gold when the crisis hits. Position yourself in your career to be as indispensable as possible. Develop skills that are in demand regardless of economic conditions. Build multiple income streams so you're not dependent on any single source. And perhaps most importantly, cultivate the right mindset. Practice thinking contrarian. When you see news of market highs, think about risk. When you eventually see news of crashes, think about opportunity. Train yourself to be calm and rational when others are emotional. This mental preparation is what separates those who profit from those who panic. The crash that may be coming in 2026 will be remembered as either the disaster that destroyed your wealth or the opportunity that created it. The difference won't be luck. It will be preparation, knowledge, courage, and action. The wealthy understand that crisis and opportunity are two sides of the same coin. While others see only the crisis, they see the opportunity. While others are paralyzed by fear, they're energized by possibility. While others are selling in panic, they're buying with confidence. The question isn't whether there will be another crash. Economic cycles are as certain as the changing seasons. The question is whether you'll be ready to profit from it when it comes. Start preparing today, because the actions you take in the next months will determine your financial reality for the next decades. The greatest transfer of wealth in a generation may be just around the corner. Make sure you're on the receiving end.